Hi, I'd like to first start by introducing my fellow panelists. First, we'll start with John Freeman. John is a partner at Coller Capital. Coller is a global secondaries business. He's responsible for portfolio construction and risk management. Next, I have Melissa Dickerson. Melissa is the CFO and head of operations at Genstar Capital, which is a $19 billion private equity firm. And Steve Darrington. Steve is the CFO of Phoenix Equity Partners, a £1.5 billion private equity firm. And I am Sally Dornaus. I am the CFO of Bain Capital's capital markets businesses, mainly made up of credit, and we manage about $45 billion. And our panel today is to talk about risk revisited. So in the current environment, talking about how effective were our worst case scenario plans, how has risk management changed, how do we embed lessons for today and looking forward when we've gone through three theoretically once-in-a-generation events in the form of 9/11, the GFC, and currently in the middle of COVID, and how do we think about risk management and the overhaul and looking forward. So first I'll start with John, just to give his thoughts overall on that as a topic and what we're looking at today, and maybe how we view this versus the scenarios we've been through before and what we think about going forward.
Thanks, Sally. I think for me, one of the things that struck me when the panel was being framed, this question about it being a once-in-a-generation event, all three of these were to a certain extent predictable. None of them are actually black swans. If anything, they're probably a grey swan because a pandemic was on the cards, and of course we had a near run with swine flu. So all of these things are things that could be predictable. What I think is interesting is actually it's the response. It's the things like the extent to which the Fed and other central banks have reacted to these events that actually have been harder to predict. So for me, that was kind of the interesting element here.
Yeah, I agree. And I think each of us being in slightly different businesses, I think react to that differently. Certainly being in the credit business versus the secondaries business, we might actually have some more similarities in how we see kind of the granularity of the risk that emerges based on that. But Melissa, I wonder how you look at it from a private equity perspective.
So, I agree with John that I think that this was, predictable is one way to look at it. I think we've lived through, in my lifetime, at least a lot of things. Hyperinflation in the 70s. I'm aging myself a little bit. The Cold War, a nuclear threat. So this is, again, just a nice catalyst and reminder for us to be aware that these risks are around the corner. I know that humans can be complacent, but these things come up every so often, and we are reminded that we can't control life, and we have to be thinking about these contingencies. So I know that I do think there's a little bit of a change in this instance, and also the Great Recession, in that I think there's more interconnectedness now, and we're more of a global world, and these problems are global. And so I think going forward, our perspective has to be broader, and we have to think in that global framework, because my choices in California certainly could impact folks across the world, and vice versa. And so these are tough problems. I don't have answers to, but I think these are things we should be talking about and thinking about. Climate change is a great example of a global problem that impacts our businesses and the choices we make in business, and how do we tackle that? So those are some thoughts I know I've had recently, and I've tried to tackle, but obviously not successfully. So,
and I think you're right in how you think about what we change going forward and how we frame that. Steve, I wonder if you have some thoughts on that, on how we look forward and how we address the current situation versus what we'll think about and changes we might make going forward.
Yeah, I think the first thing I'd say is if you didn't see it coming, don't feel too bad. I've got here a thing called the Global Risk Report 2020. It's the 15th annual risk report that's produced for the World Economic Forum. And on page 2 of the 160-page report, they issue the 10 most likely risks to happen during 2020, and then they rank them the 10 most significant impacts. Given that I think on the 15th of January, when this report was issued, Wuhan was actually in lockdown. In terms of likelihood, the infectious diseases global pandemic doesn't appear in the top 10 at all. In terms of impact, infectious diseases comes in 10th. And so I think it's fair to say that even sort of the cutting edge of risk professionals, when they sat down and looked in their crystal ball for 2020, didn't see it coming. And I think it's kind of I use an analogy, which I know you know is coming, of you're walking down the street, you see a man carrying a hammer. There's no reason for you to act in any unusual way or behave any differently. That man may have just gone to the hardware store to buy a hammer. If that man, as he walks past you, sort of hits you in the head with the hammer, you're likely, if you ever see a man carrying a hammer in the future, to behave very, very differently. Now, the problem with that method of risk management is in order to learn, you end up with a fairly sore head. And I think that the challenge for all of us is to try and apply risk management in ways and within frameworks that allow us to look forward and to some degree to anticipate. The challenge with risk management is we tend to do it. We call it a 1 in 100 year event because we kind of look back over 100 years because we can't look forward over 100 years. And we say, well, how many times did it happen? And therefore that is by definition the likelihood of it happening again. And I think what we've seen over the last 20 years is the multi-100 year event has started to accelerate. And I think, there will be lists on the list of the 10 most likely things. Climate action failure is one that is quite high up. That hasn't happened this time yet, but we pretty much know it's going to. And I think perhaps COVID will help us sort of conceptualize a little bit more clearly the fact that it is going to happen, and therefore we do need to take risk management in that area seriously. So I think the big challenge is to stop managing risk in the rearview mirror and to build frameworks and learning to be able to allow us to look forward a little bit more.
And I think that's, oh, sorry, go ahead, Melissa.
Sorry, no, I was just going to say that I really agree with that too. And I'm hopeful that this experience with COVID not just kind of gave some experience to folks that have just lived through the 10-year bull market, but also will catalyze us to make some significant changes on those big problems that we're facing. Because we've identified climate change as a big problem for a long, long time, but we haven't really made collective decisions and changes to really impact that. And so I guess I'm hopeful that this will allow us to hopefully adopt, more of this, more Zoom meetings, less CO2 impact to the globe. And hopefully that will make a meaningful impact, along with maybe other decisions as we're thinking about going back to work, will make a meaningful impact. If we keep some of that in our perspective, I'm hopeful that it will create some great change, because right now we're living through significant change I don't think we anticipated. And so, we should just take advantage of the moment.
I think it's interesting though, because to Steve's point, I mean, we're grizzled veterans, and I think when we're having a pre-conversation about this panel, the point was made that part of our job is to educate and actually to help advise people who haven't been through multiple crises. So if somebody's walking towards you with a hammer, your job is sometimes to say, actually, I don't think he's going to hit us. So I think what's interesting is it's the ability to use that experience to bring some flexibility to the response of your organization and to help temper if people are gun shy, stroke hammer shy, try and say to them, this is perhaps not the worst outcome. This is maybe the way we can take advantage of this opportunity, because all of these things, whilst individually create huge problems, they also create advantages and opportunities to invest and to do well out of them as well.
I think that's right. When we think about, certainly our younger generation, as Melissa said, have only been through a bull market. and now we're experiencing this. What's the right framework going forward so that in a few short years' time, people aren't forgetting that this is something that we went through, and taking things that we're doing now and lessons now and actually perpetuating them so that we can continue to learn from it.
And I think to your point about the sort of the generation who've only experienced upside, one of the messages we can quite, I think, successfully go through with them is to show them that what happened in the GFC, and the fact that actually the GFC happening has allowed COVID to be significantly less severe on the global economy. If we'd had weak banks and weak financial institutions with weak and fragile balance sheets at the same time as COVID, some of the quantitative easing and the liquidity measures that have been taken, many have been done by governments, but the governments have been given the sort of the elbow room by central banks, which are significantly better capitalized now than they were in the GFC. So we can learn, and there is a cumulative knowledge that in risk management that is valuable. I think the thing you just always have to assume is it rarely happens the same way. It rarely happens exactly the same. It'll be a variation or permutation of something possibly that happened before. Perhaps climate change will be a different one because we haven't experienced that yet. But we can learn from the past, but we've got to feed it into some level of predictive model.
Yeah, I think that, it's important to look at this as an opportunity to learn. These opportunities for change are great for investment. The great example, John was talking about too, if you think of the Great Recession, and you, Steve, mentioned it too about liquidity, and the rise of private debt came all out of the 2008 recession, and now is a big source of investing. And I'm sure that there'll be opportunities, and we're probably seeing a lot. I know not just Zoom's making out during this time, but there'll be other things that are that evolve out of this situation that'll be interesting to see. And again, that's just having the perspective that these are not times to just endure. Part of it is certainly that, but maybe pick your head up a little bit and try and think creatively about what could be around the corner, and how can we make that positive, and kind of grow from these experiences.
And I agree. And to Steve's point, we would not have been able to go through this experience as well theoretically as we have had we not had the 2008 crisis, because our banks wouldn't have been in as good a shape. And so there are good things that come out of this. And Melissa, as you mentioned, if there's less CO2 emission because we're doing Zooms and not getting on planes all the time for business travel, right? Those are meaningful changes and positive impacts, aside from just the ability to have more investment opportunities, which I think we're all seeing now, whether we're in the public or private markets, even though there's sort of a weird dynamic between those two right now, that those opportunities are there. I do think, though, that we still need to be very careful about the framework and the risk management that we put around it.
But within the context
sorry, Steve. It's interesting because if you think about it, risks that, Kim Jong-un and Trump, the markets barely gave a wobble because we had bigger problems. There was all these other things going on. And do you think we get a bit kind of complacent because of this backstop of having the central banks there, having all of this support of the market? And I think to a certain extent that flood of capital tends to squash the pricing of risk from the most to the least volatile. But do you think the market now perhaps takes that a little bit too far? It just kind of assumes that everything is going to be okay. And in the credit markets, the arbitrage happened very quickly. Snap from discounts to normal levels was a matter of days rather than months or years. So it was amazing the extent to which people were betting on the recovery, were betting on the central banks protecting and acting in a very strong way to change or to mollify the effects.
It's
Steve, were you going to say something?
Yeah, no, I think the other sort of element of context that we've got to, I think, make sure, we don't, we're not issuing T-bills here. We're investing risk capital. Slightly different nuances from, each of our particular focus, but ultimately it is our job to take risk. It's our job to get return. I mean, now with the risk-free rate, in many places actually now negative, our job is to get very many orders of magnitude, significant multiples of the risk-free rate. And even those of us that didn't studied economics many years ago, you don't get it for nothing, and so that you have to take risk. And I think our job as sort of risk professionals is to make sure, to the greatest extent we can, we don't end up doing things that are surprising. I think that's the we've got to be able to identify the risk and to some degree quantify and understand the risks that we're willingly taking. I think the problem comes in risk management is when something that you absolutely nobody thought of, nobody could have thought of potentially, or perhaps nobody thought of and everybody should have thought of, to your earlier point, John. That's when you really have got a problem. And I think that the World Economic Forum report is a good example of some of the greatest minds in risk all sat down and came to a conclusion that literally within probably 48 hours was fundamentally flawed, and yet it passed muster.
Yeah, but when you think about how you quantify the risk and kind of what your fan of outcomes could be, do you think that our downside cases going forward are going to include turning the lights off on a business, right? And will people look at you sideways because you say, oh, well, that only happens once? How do we have those conversations?
Well, certainly from our perspective, we always have as an investment committee bullet is the worst case scenario, and what is effectively the question is what needs to happen for us to lose our money. And we call it rather irreverently blob avoidance, and that is that's absolutely a conversation. Now it's a dangerous conversation because it's very, very easy, because it's a lot easier usually to quantify the downside impact of things than it is to credibly quantify the upside opportunity, and you to some degree get treated with slightly more gravitas if you're master of the downside, whereas in fact it's a very, very important balance that needs to be struck, and it's our jobs to strike that. But it is absolutely the what does it take for this to go badly wrong has to be a baseline in understanding any risk computation.
Well, and I think that I would expect to see investors be more maybe accepting is the wrong word, but just more tolerant of higher loss ratios, that there might be more volatility in their portfolios over time. Again, we've lived through this long period of growth, and volatility and loss ratios have kind of gone down overall relative to, say, pre-2008 periods. And to just, if we're looking ahead and thinking that the future might hold more volatility, that they would tolerate more of that and wouldn't necessarily just strive to just have the lower loss ratios, lower volatility. Because again, if they're after return, you have to accept some of that risk, some of that volatility. It'll be interesting to see. I'm not an expert at all.
But I think to understand your risk tolerances, you do have to have a clear idea of what your risk profile actually is. You have to go through a process of writing it down. What are we, are we investing on the basis of 1 in 20 gets 100 and the rest go bang, or are we investing that we get 3 times our money back on 99 out of 100 investment? Yeah. I think it's very important to write that stuff down and have conversations about that, in order that you really do understand. We're looking to, our job is to manage risk and to understand risk and not to have surprises. But you've got to start a journey knowing where hopefully where your destination is. And if you're a steady 2.5, 3x investor, and you invest in a hell of a lot of disruptive technologies, left, right, and center, you're probably not going to be able to make that equation work.
Yeah, and I would imagine it's going to be fluid over time too, because I mean, today we probably wouldn't invest in restaurants, but I'm sure there'll be a moment in the future where we would consider doing that again. So, those assumptions would have to just change for the forecast and what we expect to see.
And I agree, and I think that level of flexibility is important, especially as up until this point, all of our models were based on the last worst case scenario, which was 2008. And when you compared what happened today versus then, it's totally different. You know, in some respects, it's a lot worse how certainly private companies reacted to what was going on. And I think to not get caught in the trap of saying, okay, well, in the 10 years, 12 years post 2008, this is what happened, so that's what's going to happen again. And so I think you're right about the flexibility involved in how those models evolve.
I think a certain challenge that we're going to face in the future too is the growth of private markets, less transparency versus public. I don't think at this point the public markets represent the universe of businesses out there, and the private markets continue to just represent more and more of the businesses that are out there that we're investing in. So, I mean, right now we can look at the public markets and try and glean some forward thinking or, you know, overall economic perspective. But I think the more private overtakes public, the less a bellwether those public markets are going to be, and the tougher it will be for all of us to anticipate macro trends.
And I think another point, which is just like the GFC had some very positive outcomes. You know, it strengthened balance sheets. It was more focused on the medium-term security of financial institutions. I think we should avoid the assumption that the C19, for C19 to be over, everything has to go back to the way it was. And listen, I think you've already made, there are huge lessons to be learned, you know, not just Zoom, but, you know, they could have a fundamental impact on the office property market, use of technology, working at home, people's aspirations, people's willingness to come in and work in a sort of conurbation 5 days a week. So that, you know, I think being able to hitch on to some of those fundamental changes that are, you know, when you throw everything up in the air, things don't necessarily come down exactly the same way, and being able to identify some of those changes that actually will stick and that will have longer trends. I mean, Zoom is definitely of the moment, but I'm sure that there will be lots and lots and lots of companies that identify sort of micro trends as a result of this disruption that win out, and in 10 years' time we look back and say, wow, that company wouldn't have never have existed if it wasn't for C19, and that's a sort of positive risk management function.
And some of those elements are actually quite correlated across your portfolio. These second or third order effects, which are the hardest ones to predict. I mean, when COVID hit, we saw the whole market drop as everyone went, crap, this is really terrible. And then we saw a recovery of sorts, but we actually saw people starting to sift into winners and losers by sector. And now, of course, within sectors, they're going, well, actually, these are the winners in this sector and these are the losers. So we see this kind of granularization. But the problem is that some of these second and third order effects can be quite correlated across a portfolio in a way that you never foresaw. You know, these effects, you can always expect what's happened before. You can always plan for that, but you can't plan for these unexpected, correlated second, third order effects. And those are the ones where you have to have a framework that is flexible in terms of adjusting either what you do. And we invest discrete pools of capital. So each portfolio, each fund has to stand by its own. So you have to make sure that you're not overexposed by vintage, by geography, by particular sector, whatever. But you have to really retain the ability to change that mid-investment period. You have to be able to switch direction. And actually trying to convince people that there is opportunity and that this is what we should be doing is a tricky part. And having that experience and having the ability to be a voice in the room to say, actually, sit on our hands and be paralyzed. Because one of the problems with all of these crises is that the simplest thing, the safest thing to do always feels like nothing. Feels like putting your hands in your pocket is always the safest thing to do. But of course, if you find yourself 6 months down the line and you've actually out on a huge opportunity, you'll be kicking yourself. So it's the ability to try and push others in the room to contemplate something that they probably feel a little bit hammer shy about.
Yeah, and I think right now, as we talked about, we can't look back yet, right? Because we're still in the middle of it. And so it's hard to even see how much more opportunity is going to present itself, because we're sitting here saying, oh, these are the things that are helpful to us now, and these are the changes we'd like to make, but that's going to evolve over the next, couple of months. And then I think, Steve, I think you said it, it's how we emerge from this, and we look back, and the way we do things will be different. The way we approach office space will be different. The way we approach work from home will be different. And so I think that obviously impacts, that's not just our business, right? That impacts everybody's business, whether it's a restaurant or a technology company. And so I think that it's important to say, like, we're no experts right now because we're in the middle of it. So we only have about a minute and a half left. So wondering if anybody wants to give their last thoughts. We can start with John and then go around.
Oh wow, right in the spot. I think the first thing I'd say is I just don't put myself in the. It's good to know you don't know everything. I know if that sounds a bit crazy, but the easiest thing to be complacent is, I've seen something like this before, and this is how we should keep that open mindset and that flexibility. And for me, there's a breadth in terms of your own interest, the way you read and what you look at, because you can always find something that may not be front and center about your business, economics or whatever, but actually can be relevant and interesting. So that's my thing, is to stay broad and stay flexible.
Right. And Melissa?
So yeah, I'd agree 110% to remember and keep in mind that the challenges we face in the future are going to be broad and global, and to think smart about that is occasionally drawing analogies from other industries, other professions, other ideas. If it's, you look at art or music or whatever, to draw those analogies to help you think well about and solve these problems as we encounter them, but to just keep that open mindset and be flexible, for sure.
And Steve?
I think there's so much technology and risk frameworks, and the discipline of risk has moved on a huge order of magnitude in the last decade. But I think you've got to make sure there's always room for the emperor's new clothes comment in the room, because if you can conceptualize it, it can probably happen. I think we're now finding. So back to our friends at the World Economic Forum, they had all the data in the world, they had all the cleverest people thinking about it, and it was staring them in the face. They didn't see it. And so I think just to remember that the left field suggestion, it's just worth giving a few minutes thought to and just play it out. Risk management's playing out scenarios, even though on first blush they may seem slightly crazy.
Thanks. So I'd like to thank you all for your time. This was a fun little snippet on risk management. And then for everybody at the conference, if you'd want to contact any one of us, you can get our information through the conference directory. Appreciate it. Thanks, guys.
Thank you.
Thanks, guys. Thanks, Sally.
Thank
Cheers.
you.
Thanks.